Monday. Kyle Kuster here again, and Jamie Sumner as well for that economic update we promised last week.
Yeah, so what we want to do is start off just looking at the release of the fourth quarter GDP. This is the second release, and it came out at 1%, higher than what the advanced release was at a 0.7. So that's a promise there. And we can break it down when we're looking at GDP and the main components. As you know, we had the personal consumption, the consumer portion, which makes up a little more than 68% of the GDP. And you can see the advanced release contributed 1.46% of the GDP, and now it's down to 1.38. That's an important reduction there. If you look at the year-to-year or the quarter-to-quarter changes in that level, we can see that the consumer increased over the advanced 2%. Now, previously it was 2.2, so you see a reduction in the overall consumer expenditures, and that's something we need to keep an eye on there. Looking at the private investment, looking at what we had in the advanced release at negative 0.41, and now we're down to negative 0.12. That's a big move, contributing an additional 29 basis points inside the GDP. Very important. A lot of that came in terms of the inventories. Inventories didn't shrink as much as they anticipated. And then we see the government expenditures, another big player in here, moves from 12 basis points down to a negative 1 basis point, or negative 0.01. So that's a 13 basis point reduction inside the GDP level. And that's something we need to keep an eye on. A lot of that was the national defense and not spending as much as they anticipated. Then we had the net exports here moving from negative 0.47 down to a negative 0.25. Again, picking up a little more there, and a lot of that had to do with imports being less, and that picked up 22 basis points. So overall, we saw that overall rate go from the 0.7 to a 1%. But we need to keep an eye on, which is positive, but we need to keep an eye on this personal consumption number, because that actually came down when we looked at it from the advanced release to the second release.
So we get a chance to talk about GDP, and then there's another component that we really need to keep an eye on, and it's the inflationary portion of that. Now, last week you mentioned the FHFA's release was coming out, and that's going to give you a housing price index indicator. This is straight from the report that they had just released, and what it's showing you is a nationwide four-quarter growth rate in home prices. And what you're going to see here is the Northeast is relatively slow and stable growth. We'll discuss this. It's a little bit below average, so it's something to keep in mind with your lending portfolio, the local market. You're really going to need to consider that, at least here from a regional aspect. This report also goes into metropolitan statistical areas, so you can kind of zoom into a little bit of a more local aspect in this. But what I really want to point out here is look at the Pacific area here in the West. Colorado, 11% growth over the year. Nevada, now we can definitely chalk that up to recovering from, let's talk about Las Vegas home prices. I mean, they
severe reduction in its home prices.
Yeah, so that might be a bit of recovery. California's around 7%. Oregon and Washington, that's another 10% right there. So those are considered above average for the growth rates. But we'll see on a nationwide basis in the next slide that we need to keep an eye out on these more explosive growths. And you don't want to say bubble yet or anything like that. I mean, that's nationwide. We were looking at around a 10% home appreciation, price appreciation. We're nowhere near there, but we have been increasing a bit. Based off of the data, which is only available to 1991, to me it looks like this would be like roughly a mean in this trend, and you can see it we get too high, it's going to revert, but of course we have a crash here with the recession, and now we're kind of zeroing in on that area again. So, those 10% growth rates in the West Coast, they're nothing to really worry about unless it's a continual trend. You're seeing 10% over the next, continuing into the next year. Now, this is quarterly data. It's a little bit lagged. This came out last week, and it's representing the fourth quarter of 2015 is our most recent spot here. And then the next home price information, this is going to be from the Census Bureau, and it's a little more recent, but we're showing a different picture. We're not actually showing an appreciation in prices. We're more recently showing a significant depreciation in the median sale price. Now, these are new homes.
Yes.
And the other indicator was an overall existing and new homes purchase-only index. And I like that, the purchase-only index, because part of some of the real estate issues we had in the past might have been related to the estimations or appraisals of houses being a little excessive. So the purchases are the actual true numbers that people are buying the houses for.
And the new home sales number we saw come off, coming down to 494,000 homes, new homes being sold last month. That's down from 544,000. So we saw that decline by about 4%.
So that's all we have for you this week. I'll put something in the email this week. Please, if you have any requests, Jamie and I would be happy to discuss any specifics that are out there, whether it's banking related, economic. So please contact us. We'd be happy to do an extra special briefing when we can. And next week, I believe we have Jay back.
Yes, we do. All right. Have a good week, everyone.
Thank you.